Okay, looks like we're right at noon Central. So I will officially kick things off. I want to say welcome. This is our 7th session of our 2024 Yellowbook training series. I'm Rachel Windett, and I'm with Sikich University, and I will support you all on the call today. We're also joined by Rachel Hawley with our marketing team. She and I will be screening questions and comments as they come in. If you do have any questions or comments, please feel free to throw those into our chat. We do love engagement, encourage those questions, comments, which we will communicate to our presenters today. For CPE, we will have 3 polls. As they come up during the session, please take a moment to complete those. All 3 polls are required for CPE credit. This recording will also be made available on demand in a few days following the event. An email will be sent with that information. For this session on long-term debt, we welcome Kellen O'Malley and Martha Trotter. Kellen is a senior audit manager with Sikich and specializes in manufacturing, distribution, and governmental entities with a focus on cities, villages, and park districts. Martha is a principal with Sikich and specializes in governmental entities, providing governmental accounting, auditing, financial reporting, budget development, revenue, and expenditure forecasting, as well as cash and debt management. So thank you everyone for joining us. I will officially hand it over to our presenters today, Martha and Kellen.
Thanks, Rachel. Hello, everyone. As Rachel mentioned, I am Martha Trotter. I'm a principal with Sikich. I actually started my career at Sikich when I graduated from U of I in 2011. So I've been with Sikich for 13 years. And I have been servicing the state and local government industry in my entire career. With me presenting today is Kellen O'Malley. If you've joined us in any previous webinars, you've probably seen him before. Kellen?
Hi, yeah, I'm Kellen O'Malley. I'm a senior manager here at Sikich. I've been on the state and local government team for about 8.5 years now. I'm looking forward to discussing long-term debt with you today. Speaking of long-term debt, I'm also a new dad. If you didn't get that, it's okay. It's my attempt at a dad joke. If you didn't get it, it's it typically doesn't go well if you mix long-term debt jokes or accounting jokes with dad jokes there. But with that, I'll turn it back over to Martha and get it started on the presentation.
Well, Kellen, hopefully after our presentation today, nobody's losing sleep over accounting and reporting for long-term debt.
Yeah.
You'll have a few years before you get some good sleep.
I know I'll be losing sleep over other things, so.
All right, I'm going to jump right in and begin with talking about your debt service funds. So typically oftentimes where you'll be recording your debt is repayment transactions. So debt service funds are one of 5 governmental funds as defined by GASB Statement number 54. As all governmental funds, debt service funds report on the current financial resources measurement focus. You're reporting your current assets and current liabilities. These are reported on a modified accrual basis of accounting. Oftentimes, your debt service funds is where you'll be accounting for your payments of governmental debt, in particular if required by any bond ordinances or from a managerial requirement. Revenues in debt service funds, as all governmental funds, are reported when measurable and available, and your expenditures are reported when due, meaning when the obligation is matured and payable. Most debt service fund revenues are derived from non-exchange transactions. Typically, you'll largely see property tax revenues reported, some interest income. In terms of the expenditures, these are recorded when due, meaning when your obligation is matured and payable. You may transfer cash to a paying agent prior to the maturity of your debt. In these cases, this transaction is moving from a current asset to a restricted asset. There is an exception to this rule, however. If your debt obligation payment is due shortly after your fiscal year end, you can accrue your liability and expenditure at year end. An example of this is if you have a December 31st fiscal year end and your debt payment is due January 1st, you may have transferred your cash to a paying agent. You can, in that case, report the liability and accrue your expenditure at December 31st. An example of the journal entries that you would record when reporting your principal and interest payments in your debt service fund or in your other governmental activities, in your other governmental funds, you have your debit to report your principal expenditure and interest expenditure and your credit to cash when the payment is made. In the exception just noted before, rather than crediting cash, you would be crediting your bonds payable and interest payable in that case. One thing to note on the journal entry, for financial statement presentation purposes, you do want to report your principal expenditure separate from your interest expenditure. In the GASB 34 account grouping, so to capture your governmental activities, entity-wide full accrual financial reporting, you would record a debit for bonds payable, so the reduction of the liability, and your offsetting credit would be to principal expense. Your entity may issue debt that is being repaid by others. In this instance, you would show a receivable, a deferred inflow for the unavailable revenue, and as you collect revenue from the other entity, you would reduce your receivable. Examples of this type of debt issuance would be if a village issues debt for a village library, for instance, or if a village issues notes which are to be paid by a developer. Because the village is the issuer of that debt, the debt must still be reported by the village. So that's why in this instance you show your receivable and deferred inflow in the governmental fund. We see similar accounting to this in recent years for any government that has reported a lessor arrangement in a governmental fund for GASB 87. So we've been seeing more frequently the long-term receivable and offset of the deferred inflow in a governmental fund. For governmental activities debt, we encourage tracking this in a general long-term debt account grouping or GASB 34 account grouping as we currently refer to it. This is not reported as a column on your basic financial statements since 2000 and onwards. However, we do encourage maintaining your GASB 34 or GLTDAG fund in your general ledger. Maintaining this fund assists in the conversion of your governmental funds to governmental activities to the entity-wide financial statement level. And it also assists with the preparation of the footnote disclosures. Essentially, maintaining your GLTDAG makes it possible to reconcile your general ledger to the entity-wide governmental activities financial statements. If you have not set up a GASB 34 account grouping or GLTDAG for your long-term debt, we encourage you to talk to your auditors to get some examples, and we do highly encourage reporting this, maintaining this activity in your general ledger to assist with your reconciliation of the financial statements and to make sure your system has a full reporting. And that takes us to our first of 3 poll questions.
Okay, I have launched that poll, so please take a moment and reply. especially for CPE credit. We need a response to all three.
Select all that apply. Which of the following forms of long-term debt does your entity report?
Give everyone a couple more seconds to reply. Okay. I'm going to close the poll.
Looks like everybody reports just about all of our options here.
And there's so many more beyond what was presented as well. So in regards to different types of debt issues, I will be talking for a moment about general obligation bonds, as these are the standard debt vehicle for many governments. As noted in our poll question, many of you report general obligation bonds. Historically, this was the only type of debt that was issued by governments, and because of that, many of the GASB standards are written specifically for general obligation debt. General obligation bonds are backed by the full faith, credit, and taxing powers of the issuing government, and as such, they are always recorded by the issuing government. Now, there are other debt vehicles that are also common, as you saw in our polling question, and beyond that, you may have debt certificates, alternative revenue source bonds, TIF bonds. I'll discuss some of those in a few moments as well. For the next few slides, I'll be focusing on general obligation bonds. This slide and the next slide discuss the GASB pronouncements, which provide guidance for accounting for debt issues. As I noted, because historically general obligation bonds were the only bond debt issues by governments, many of these pronouncements do focus on, are written specifically for general obligation debt. However, when determining how to account for debt, when reviewing the pronouncements, it's important to remember substance over form. You want to pay attention to the substance of the transaction rather than the legal form of the transaction. Something might be called a lease, but in substance, it is a note payable. You've maybe seen this a lot more in recent years with the implementation of GASB 87 and GASB 96. As you've been preparing for the implementation and reading through the variety of possible contracts that apply under those pronouncements, you've maybe found that certain agreements are structured as rental agreements but are truly leases. So that's why it's so important to remember substance over form as the overarching principle to apply when determining how to report your debt obligations. When determining if debt needs to be reported, you need to consider whose debt it is, whose name is on the debt, who is obligated to pay. GASB 34 provides that all debt should follow the capital asset. However, there are instances in which this isn't the case. For instance, you may issue general obligation bonds where the repayment is made by enterprise funds, or you may have a general obligation debt issue where the repayment is made in governmental funds. However, the capital asset being constructed or paid for is related to an enterprise fund asset. In those instances, when calculating your net investment in capital assets for your statement of net position, the debt applies to the governmental activities calculation. However, the capital asset is reflected in the enterprise fund and business type activities calculation of the net investment in capital assets. And in these cases, your net investment in capital assets actually does not cross-foot to the total column. So this would be a footnote disclosure on your statement of net position describing where the debt is issued and what capital assets it relates to. Moving on to other types of debt issues. Once again, we always want to ask, whose debt is it? For limited obligation debt or other types of debt, you still need to consider whose name is on the issue and who is obligated to pay. There's GASB's statement number 6 provides some clarification, and GASB interpretation number 2 provides some information along with GASB statement 91 regarding conduit debt to assist in determining whether debt is to be recorded or footnote disclosed only. These pronouncements discuss special assessment debt, conduit debt obligations. Special assessment debt is debt that finances activity for benefited property owners, not the government as a whole. And this may be similar also to special service area debt issuances. The classification of special assessment debt depends on what type of underlying debt was issued. You may have general obligation special assessment debt, limited tax special assessment debt that is secured by liens on the benefited properties, that is backed by the full faith, credit, and taxing power of the government, that is reported the same as general obligation debt. You may have limited tax special assessment debt that is secured by liens on the benefited properties, but not backed by the full faith, credit, and taxing power. But there might be some other limited form of security offered by the government. For instance, certain amounts of sales taxes or utility taxes may be pledged to cover defaults on that debt. You may have limited tax special assessment debt that is secured by liens on the benefited properties, but not backed by the full faith, credit, and taxing power, and does not have any pledged revenue sources. So we come back to our question, whether this debt is obligated in some manner or not obligated, and that will help you determine whether it must be reported on the face of your financial statements or not. So how do you determine whether such debt is obligated in some manner or not? GASB Statement 6 provides information on this. On this slide, there's a few bullet points listed to provide some guidance. So if the government is obligated to honor deficiencies to the extent that the lien foreclosure proceeds are insufficient, if your government is required to establish a reserve, guarantee, or a sinking fund with other resources, if your government is required to cover any delinquencies or defaults, and if your government is required to purchase all properties that were not sold at public auction or through other means. If any of these apply, there is an obligation by your government. In practice as well, there may be some not as explicitly stated determinations to assist in determining whether you are obligated in some manner on that special assessment debt. So if the government is authorized to establish a reserve, a guarantee, or a sinking fund, and it does so, if there is any explicitly indicated language in the contract that discloses that your government must cover delinquencies, regardless of the legal obligation to do so, or if they're in practice or historically, if your government has issued similar debt and has, regardless of any explicitly stated requirements, has assumed responsibility for the debt in an event of a default. Those are in practice some ways to determine whether you have the obligation and if that debt should be reported on the face of the financial statements. So if any of the previous criteria were met, the debt is reported on the face of the financial statements. If you do not meet any of the previous criteria, then you are not obligated in any manner. In that case, what is required from a reporting purpose is footnote disclosure only. So this is where you see footnote disclosures related to conduit debt obligations, for instance, where you do not record the liability, but you do disclose the agreements in your long-term debt footnote disclosures. If you determine you are obligated in some manner, you would generally use the same accounting and reporting as you do for general obligation debt issues. If your determination is that you are not obligated in any manner, then the debt is not reported as a liability on the financial statements, and your only requirement from a reporting purpose in that case is to have your footnote disclosures of the debt. So your note disclosure, you would want to discuss that the government is acting in an agent capacity and collecting taxes from benefited property owners and remitting those to bondholders or to a paying agent. In instances where you are not obligated in any manner, the proceeds of the debt are reported in your capital projects fund or enterprise fund, like a water or sewer fund, depending on where the capital asset that is being purchased and constructed resides. You would show a credit as contribution from property owners, regardless of who gets the proceeds. For the repayment of that debt, you may have a custodial fund set up to account for the collection of taxes from the benefited property owners and remittances of those to the bondholders or paying agent. There are other forms of limited obligation debt that you may encounter, such as tax increment financing districts, TIF notes or TID notes, depending on where you reside. You may have other limited obligation debt, revenue bonds, for instance, that are repaid from resources other than property taxes. You still record those as a liability of the government that issues the bonds, and you may have footnote disclosures regarding the pledged resources or the revenue streams that are used for the repayment of those issues. You may have notes payable that are issued to a developer where you don't receive any cash proceeds. In those cases, as the government issuing the debt, if your name is on the debt issue, you still record that liability. So you still report that increase in long-term liabilities, and your issuance of the note is presented as an other financing source for use, offset by the expenditure for the eligible costs that are incurred. Your limited obligation debt, you would use the same accounting and reporting as other debt issues. The footnote disclosure should also discuss the limited nature of the obligation. And similar to special assessment debt or TIF and revenue bonds, you may have special service area debt. If the special service area covers only a portion of your community, you would apply reporting similar to special assessment debt. If the SSA debt covers the entire community, you would apply reporting similar to TIF or revenue bond guidance. That brings us to our second of 3 poll questions.
Go ahead, Kellen.
So the question is, does your entity maintain a GASB Statement 34 accounting grouping to track your governmental long-term debt? Abbreviated form would be GLIT tag. So it looks like the majority of us do use that, and certainly something that we recommend, as this, helps with the conversion entries as it relates to recording that long-term debt. Provides, kind of backup from a governmental wide standpoint, as to what you are converting from your governmental funds into your government wide financial statements there.
It certainly makes preparing your footnote disclosures and reconciling your financial statements much easier if you do maintain that GASB 34 account grouping.
Yeah, definitely. I completely agree. So continuing our discussion on debt issues and retirements here, and taking a look at GASB interpretation number 2. GASB interpretation number 2 provides an additional definition of no commitment debt. This interpretation provides disclosure requirements for conduit debt obligations. Conduit debt obligations are debt instruments issued by a state or local governmental entity for the express purpose of providing capital financing for a specific third party. Typically, this would be like a private entity. And the key here is that it's not part of the issuer's financial reporting entity. And just want to emphasize that it's not part of the government's reporting entity. It is, however, issued in the government's name. This would be secured by a lease with a private company or a mortgage with a third party. And different types of conduit debt include IDRBs, industrial development revenue bonds, IRBs, or mortgage revenue bonds. Again, these typically provide financing for a private entity, but benefit the local community there. And however, this does not apply to special assessment debt, which Martha discussed on a previous slide there. So how do we report conduit debt? And you can go to the next slide, Martha. The short answer is we don't. It's not the balance isn't recorded in our financial statement balances at all. However, as Martha mentioned earlier, there are certain disclosures that are required. So within your notes to the financial statements, we are required to report a general description of the conduit debt transaction, the aggregate amount of all conduit debt outstanding at fiscal year end, a clear disclosure that the government is not obligated, and just want to note that many governments do miss this disclosure, given that it's not required to be recorded in your financial statements or within your balances on those statements. These types of agreements are often out there for several years and can be overlooked. So we certainly encourage that if you come across something that you feel might qualify as conduit debt, look into it and determine whether it's still outstanding and it's something that would be required to be reported. If you're not sure, contact your auditors and discuss with them whether it's something that would meet the conduit debt agreement here. On the next slide, usually we count from 1 to 2, but here we're going to go from talking about GASB interpretation number 2 to GASB interpretation number 1. GASB interpretation 1 provides guidance on accounting for variable rate demand bonds. So this is considered to be long-term debt, and it's referred to as long-term demand debt. or in other words, callable by the holder. This long-term demand debt or variable rate bonds are generally going to have short-term interest rates. The interest rate may reset daily, weekly, or monthly. Usually these are issued at times of higher long-term interest rates, although we didn't see a whole lot of this in the recent high interest rate period we were just in, and as you know, if interest rates begin to fall, we would certainly probably expect to see less. Demand debt may have a letter of credit associated with them, or takeout agreements, just another name there. If longer than 1 year, it is considered to be long-term debt, but if it's less than 1 year, it's considered to be short-term debt. And this is really important because short-term debt can often be missed as the reporting requirements for that short-term debt can look completely different. Short-term debt would be required to be reported in governmental funds and on your fund financial statements, and can have an impact on your fund balance there. And that's why it's important that we distinguish properly between short-term and long-term debt. Short-term debt is also disclosed separately from long-term debt in the notes to the financial statements. You're required to show the beginning balance, the issuance, any retirements, and the ending balance related to that debt. And just to continue the conversation on short-term debt here for a minute, you know, it's as it's something that can be overlooked. It could have an unintentional impact from a reporting standpoint. So if you issue annual rollover bonds, if you're, you know, a park district, for example, or annual debt issues, this could impact you. We've seen this in the market somewhat to structure these bonds, where the repayment and the maturity of the bond is less than 1 year in some instances. Now, the reason for this is to reduce interest costs. However, the reporting piece of that can also often be missed. You know, when you issue the debt and the issuance date and the maturity date are within 1 year, you know, like I said, GASB requires not only for those to be disclosed separately, but you know, these would be required to be reported in your fund financial statements as governmental debt. And reporting that in your fund financial statements may have an impact on your fund balance that's, you know, wasn't intended. So you just want to make sure you take this into account and talk to your auditors or your advisors if you run into this situation. Even if there's no big change, you know, in similar instances, or similar issuances in the past, where the repayment date is just over 1 year, the reporting could be very different. And you just want to be prepared if questions come up either with the board or with others, that you're prepared to you're prepared to answer those questions. So back to demand bonds and the disclosures required by those. Within your notes to the financial statements, you're required to disclose a general description about the variable interest component. If there's a remarketing agreement, the terms of letter of credit or other liquidity arrangements, the terms of the takeout agreement, and any commitment fees paid associated with those demand bonds. So other types of debt include certificates of participation, financing with public building commissions, installment purchases or installment contracts for land and equipment. And installment purchases are one of the things I've been seeing a little bit more of, and needing to report an installment contract. You know, if for example you purchased police body cams or other equipment, we've seen those fall under the category of an installment contract. It depends, you know, you have to take a look at the agreement and determine, you know, how that agreement is structured there. But in situations where the long-term purchase, this is a long-term purchase to own agreement, it may be required to be recorded as long-term debt and as an installment purchase or installment contract. And again, depending on how that agreement is structured, it could also fall under the umbrella of GASB 96 and SPIDAs or GASB 87 and leases. So you just need to look closely as to how that is structured there. So in many instances, the government may not physically receive cash in certain debt arrangements, or the cash is deposited into an escrow account. The escrow account may serve multiple purposes, but first being the security for the bond or the note holders until the asset the debt was issued for is constructed. Those bills for construction of the asset are then submitted to the escrow agent who makes the payment. So guidance tells us we need to look at this from a substance over form standpoint. So the cash with the escrow agent must be reported by the government. So I think of this as my dad joke earlier. I definitely didn't get any bond proceeds when I got a kid, but maybe this would fall under a substance over form standpoint. On the next slide, we have an example of how this would be reported. Under governmental fund accounting, cash in escrow or cash with the escrow agent would be debited, and this would be offset by a credit to an other financing source to show the issuance of the debt. When the capital expenditures actually occur, we would then debit the capital outlay expenditure and reduce the related cash in escrow by crediting that account. So in the next few slides here, we're going to take a look at recording the issuance of the debt and how that looks on your financial statements. It's important to note that you're looking at the closing date of the issue of the debt, and not the settlement date. Generally, you're not going to see a significant difference between those. However, this could make a big difference if the dates are in different fiscal years. If you have this cross fiscal years, you need to determine which fiscal year this should be reported in, and or if you have a subsequent event footnote to record there. This is also something to think about as it relates to short-term debt, which we discussed earlier, as this could differentiate whether the debt is reported as short-term or long-term. When we issue bonds or long-term debt, this is generally reported at par value. And we also need to take into account any discount and premium related to the debt. Issuing long-term debt looks different depending on if it's issued in a governmental fund or a proprietary fund. In a governmental fund, we use the current financial resource measurement focus and a modified accrual basis. And on a modified accrual basis, the issuance of the debt would need to be reported as an other financing source in the fund that it is issued. The discount and premium is also then shown as another financing source. And then at the government-wide level, we convert to a full accrual basis. Proprietary funds use a full accrual basis, and on a full accrual basis, you're simply just going to debit your cash and credit your long-term liability accounts and the related bond and discount or premium if applicable. So on the next slide, we have some example of these entries. So again, on your fund financial statements for governmental debt, we're gonna debit the cash in the fund where the bond proceeds are going to be spent. We would then break out the proceeds and credit the respective other financing source accounts for the par value and if in this case a premium. And any difference between what the proceeds you actually get in and the par value and premium is going to be your issuance costs there. And I don't generally see this being credited, but you would debit the issuance costs related to the fees that were deducted from the cash. At the government-wide level, if you're using a GASB 34 account group or a GLITDAG there, we're going to debit the proceeds. I always think of this as kind of eliminating those other financing sources that we recorded at the fund level. So debiting the proceeds to eliminate the other financing sources, and then recording the related liabilities there. So you would then credit the liability for the par value, and then separate out the premium into a separate account. The last entry there is how it look in a proprietary fund, and that's kind of like I said, if you just eliminate the debit of the proceeds and the credit to the other financing sources and the governmental fund, that proprietary fund on a full accrual basis, we're just debiting cash, recording our issuance costs, and then crediting the related liability and premium there. So you may ask yourself, where do I get this information to record this? I can't find it in the 100+ page official statement packet of the bond issue. And the best answer is to look at your closing documents, and specifically the sources and uses page. And we have an example here of what that might look like. So listed here is the sources and uses, and at the top is the sources of the fund, and that's broken out between the par value at 10 million in this example, and the reoffering premium of 500,000. And at the bottom lists out the uses of the fund, and it's important to note that the uses of the fund here agrees to the sources of the total sources of the funds of 10,500,000. So in this example, what is actually deposited into the governmental fund or the capital projects fund, in this case it's called the construction fund, is only 10,415,000. And the difference between that and the 10,500,000 is 85,000 in issuance costs that are being deducted from those proceeds. So that 85,000 is essentially what you're going to be recording as the issuance costs in your financial statements. So hopefully that provides a little bit of clarity and where to look, as well as what to record when issuing debt on the financial statements there.
Just wanted to add to that, Kellen. So speaking to the journal entry that we just went over, oftentimes you'll need the issuance costs are oftentimes paid directly from the proceeds. So you may need to gross up your cash to accurately reflect the bond issuance costs.
Thank you. Now, when the debt when debt is refunded, those entries might look a little bit different. If you have existing debt, you may be looking to refund your long-term debt, and some reasons for that are changes in interest rates. Maybe you want to refund to take advantage of a lower interest rate environment. We certainly saw a lot of this a couple of years ago before interest rates started to rise. Or maybe you want to remove restrictive covenants, restructure the debt agreement there, or also restructure the debt service payment schedule. So there's two types of refunding: a current refunding and an advance refunding. A current refunding is when the due debt is immediately called and redeems or repays your old debt. An advance refunding, the proceeds from the due debt are placed in irrevocable trust with an escrow agent and are invested until they're used to pay the government's old debt at a future time. So advance refundings are no longer common for tax-exempt debt due to federal legislative changes there. So GASB statement number 7 defines 2 types of defeasance or advanced refundings. And bear with me here as I try to continue to pronounce defeasance. But there's 2 types of a legal defeasance as well as an in-substance defeasance. In a legal defeasance, you would deposit the full cash refunding into the escrow account. You're no longer obligated for the bonds, and then this would remove the restrictive covenants of those bonds. In substance defeasance would be when you deposit the net present value of future payments into escrow. The funds would typically be invested in secure investments, typically slugs or treasuries, and you would still be primarily obligated for the bonds. Once the debt is considered defeased, the liability would no longer be reported on the statement of net position. So how in the world do we record this on our financial statements? If there's a gain or loss related to that, we're only going to record on a full accrual basis in the proprietary and entity-wide financial statements. We need to calculate the gain or loss on refunding by taking the difference between the reacquisition price, which is the amount that is placed into escrow as part of the refunding, and the net carrying amount of the old debt. The amount is then amortized over the life of the shorter of either the life of the refunded bonds, which is the old bonds, or the life of the refunding bonds, which is the new bonds. We have a bullet point here on sample journal entries, but I'm going to skip over that today. And if you're looking for sample JEs or looking for an example, please let us know, and we be happy to assist or point you in the right direction. A journal entry year can often look very different. But one thing to note is that something that's often missed is taking into account any unamortized premium or unamortized gain or loss on the old debt that's being refunded as part of that refunding transaction. So definitely make sure to take that into account from a recording standpoint. If you enter into a debt refunding, there are also additional disclosures required to be included in the notes of the financial statements. The year the refunding occurs, you need to disclose the nature of the transaction, the cash flow difference, the economic gain or loss, which is the difference between the present value of the old debt and the present value of the new debt, discounted at the effective interest rate of the new debt. If you're looking for this information, this would be information that you can be provided by your financial advisor for the refunding or within your closing statements. The official statement will have all the information, tons of information on the new debt, but to get that economic gain or loss and the cash flow difference, you're likely going to need to obtain that from the closing statements. Lastly, you need to disclose the amount of the refunding bonds outstanding every year. So in the current year of the refunding, that would be included within your disclosure, and in subsequent years, after the year the refunding occurs, you don't need to disclose all of this information. You only need to disclose the amount of the refunded bonds outstanding at year end. The next few slides here will take a look at GASB Statement 86 and certain debt extinguishment issues. GASB Statement 86 provides the most recent guidance on certain debt extinguishment issues, primarily in substance defeasance of debt. This was issued GASB Statement number 7 and GASB Statement number 23 on debt refundings and Statement 62 on debt extinguishments were working effectively, but there were certain issues that needed to be addressed. and this has been effective since June 15th, 2017. So prior guidance provided for in-substance defeasance only if new debt was issued to refund the old debt. Statement 86 expands that guidance to allow for in-substance defeasance of debt when only existing resources are used to fund a trust to pay off that debt. So typically this is put into risk-free assets. And one of the key differences here is that the gain or loss is recognized in the period of defeasance and not amortized, such as an advanced refunding. In the notes to the financial statements, you're required to disclose and describe the transaction in the period that it occurs, just like refundings, and disclose the remaining outstanding balance in each period the defeased debt remains outstanding, and that may be combined with the refunded amount. There are also some additional disclosures on required on substitution risk. This applies to all in-substance defeasances. Typically, you're required to use risk-free monetary assets, but if the substitution with monetary assets is not prohibited, you would need to disclose that within your financial statements. So within the financial statements, you would need to disclose in the period of defeasance the fact that the substitution is not prohibited. And in subsequent periods, the amount of debt defeased in substance that remains outstanding for which the risk of substitution exists. So that takes us to our next polling question, or third and final polling question. Does your entity plan to issue debt in the current fiscal year? And do you think that you can record an advanced refunding? Sorry, second part of that question is not in there.
Looks like no is our main answer received.
All right. So in the next slide here, when we talk about debt, there are different types of debt and how it can be perceived on the financial statements. There's capital debt versus non-capital debt, or good debt versus bad debt. Capital debt is debt that produces a capital asset owned by the issuer, and we call it good debt because it also creates a financial asset and is then included as restricted as part of your net invested in capital asset or assets or NICA. So since that capital debt would ultimately be included in your NICA, then that would not reduce your unrestricted net position on the financial statements, and that's why it's considered to be good debt or perceived as good debt on the financial statements. On the other hand, non-capital debt, or debt that produces a capital asset owned by somebody else, is perceived as bad debt because this does end up decreasing your unrestricted net position because it's not included in your NICA calculation. So your net investment in capital asset can commonly be miscalculated. So when we're talking about capital debt, we want to hit on what goes into that calculation. If you submit your ACFR to GFOA as part of the GFOA award program, you also need to submit your NICA calculation now. And this is recently one of the things they're looking closely at, and you may get comments or questions on, especially if it's not calculated correctly. So your NICA calc should be the book value of your capital assets, less principal outstanding related to capital debt or good debt, as we talked about in the last slide. Important to note there that non-capital debt or bad debt would not go into your NICA calculation. The principal of the debt outstanding should include any related unamortized discounts, any premiums for that capital debt, any related unamortized gains or losses on a refunding, and it's also reduced for any unspent bond proceeds related to that debt. This debt could also relate to lease liabilities under GASB Statement 87, SPIDAs under GASB Statement 96, or installment contracts for property or equipment. You'd also need to reduce the book value of your capital assets by any retainage or accounts payable related to the capital asset at year end. This is one of the things that's often missed, so make sure you have that noted either in your capital asset work papers or somewhere else, any capital that is in accounts payable or is retainage payable at year end. So kind of one more time, just putting this all together, your NICA calculation then equals your book value, your capital asset, less principal of debt outstanding related to capital debt, less retainage or accounts payable related to capital assets equals your NICA there. If you're looking for further information on how to calculate this, GFOA actually has a tool available on their website that you can take a look at to make sure you're incorporating all of the required pieces as part of your calculation. So last but not least here, going to take a look at GASB statement number 48 and pledged revenues. On the next slide, GASB 48 does not apply to a pledge of full faith and credit or general obligation debt. It does, however, apply to alternative revenue bonds and revenue bonds that contain pledges of future revenue streams for the repayment of the debt. As long as the bonds are outstanding, you're required to add some disclosures within your financial statements. In the notes to the financial statements, you need to disclose the specific revenue pledged and the amount of the total pledge, purposes of the debt secured by the pledged revenue, the terms of the pledge, the amount of pledged revenue as a percentage of the total revenue stream, and the coverage there. So that leads us to the end of our presentation. So I want to first thank everyone for joining us today. Looks like we're about right at time, but I don't know, Rachel, do we have any questions? Do we have time for questions?
We do. Let me navigate to that area. So we did have one question that says, we have a situation with a debt payment due the first of the fiscal year, but the cash gets moved in the previous fiscal. Our auditors have required we use a prepaid. Is that not necessary?
So the liability would be reduced in the period that it is due. But if it's being paid before year end, I believe that would be reported, and Martha, please correct me if I'm wrong, I believe that would be reported as a cash with fiscal agent on your financial statements. Martha, it looks like you're muted.
I was, thank you. Right, we covered it on a few slides briefly. So if you're making your payment to an escrow or paying agent, the obligation is not extinguished until the date of maturity. So you're still obligated to pay that debt obligation still exists at year end. So that's where you would reflect a cash with paying agent on your financial statements.
Got it.
Okay.
Awesome. Well, that's all we have. Thank you everybody for joining us, and we hope you join us for session number 8 with Tom Sawicki and Victoria Daly on accounting for cash and investments. I think that's September 11th, if I'm not mistaken. But yeah, thanks again.
And if there were
Rachel,
any other questions that came through, we'll address those directly with you. We'll reach out.
Yes.
Thanks so much.
All right. Thank you all. Have a great rest of your day.